Opendoor has just come through another big day of trading, and for many people watching, Monday may have looked like a setback. After all, the stock fell about 9% to close at $4.54 per share. But to me, this wasn't a collapse or the start of a reversal. It was a healthy pullback, a natural cooldown after the kind of rally we've just seen, and part of the volatility that comes with a stock in transition. Heading into Tuesday's pre-market, I remain bullish that this story isn't finished. In fact, the bigger picture looks stronger than ever. Let's start with Monday's trading action. The stock opened strong, riding the momentum from last week's breakout, and it climbed as high as $5.87 intraday. That's a big move, and it came on strong volume early in the session. But as the afternoon wore on, profit-taking kicked in. Shares pulled back sharply from those highs and settled at $4.54, about 9% lower on the day. Now, at first glance, a 9% drop looks painful. But here's what matters: the selling came on lower volume than the buying that pushed the stock higher. That's a critical point, because it shows that the pullback was more about traders taking profits than about heavy conviction selling. When a stock has just risen 40% in one day, and another 20% intraday the next session, you expect some people to lock in gains. That's normal. That's healthy. It's part of the rhythm of a volatile stock. And let's be honest, volatility is the name of the game with Opendoor right now. This stock has become one of the most talked about names in the market, and with that attention comes rapid swings in both directions. But the important thing is that despite the pullback, the underlying conviction hasn't disappeared. In fact, many of the most vocal voices around Opendoor, from Eric Jackson to Anthony Pompliano, are saying exactly what I am: this was a healthy pause, not the end of the rally. Eric Jackson, who has been front and center in this story, even acknowledged that volatility like this is to be expected after the kind of week Opendoor just had. He continues to emphasize the long-term potential, reminding everyone that his $82 price target is not about the next week or the next month, it's about years of evolution and growth. And Anthony Pompliano reinforced the same point, highlighting that retail investors have to expect volatility in a story that's being driven by cultural energy, strategic change, and macro catalysts all at once. So what makes me confident that Monday was just a reset and not a reversal? It's the convergence of three factors: momentum, macro, and model. First, momentum. Even with the pullback, Opendoor is still up dramatically over the past week. The rally from sub-$3 to above $5 was one of the sharpest moves in the market, and Monday's dip hasn't erased that. In fact, the way the stock held above $4.50 shows that there's still a strong base of buyers stepping in. Dips like these are opportunities for conviction buyers to add, and retail has proven time and again that they are ready to step in. Second, the macro picture is still highly supportive. Jerome Powell's comments at Jackson Hole made it clear that the Federal Reserve is preparing to cut rates, likely in September. That's a game changer for housing. Lower mortgage costs mean more buyers can afford homes, more sellers are willing to list, and transaction volumes rise. For a company like Opendoor, which thrives on activity, this is the kind of tailwind that can drive meaningful growth. It's not about one day or 1 week, it's about the environment shifting from headwind to tailwind, and Opendoor is perfectly positioned to benefit. Third, the model. What makes Opendoor unique isn't just its iBuyer roots, but the fact that it's evolving into something bigger, a seller-first platform that could reshape the real estate market. Eric Jackson laid this out clearly in his recent interview on The Rundown. Unlike Zillow or Redfin, which are primarily ad-driven platforms catering to agents, Opendoor starts with the seller. And without sellers, there is no housing market. By focusing on the supply side, Opendoor has the chance to do what Uber did for ride-sharing and what Airbnb did for lodging, fundamentally change the dynamics of the industry by owning the foundation. That idea resonates deeply with me, because it captures why Opendoor's long-term story is so compelling. This isn't about hype or meme stock chatter. This is about a business model that can scale, that can leverage technology, and that can capture a structural advantage in one of the biggest markets in the world. And technology is exactly where Opendoor is doubling down. Acting CEO Srisha Radhakrishna has been vocal about making AI a core primitive for the company. He's admitted that just a year ago he wasn't convinced AI was ready for real work with real money at stake. But now, after seeing tools like Repair Copilot and Risk AI built and deployed in a matter of weeks, he's convinced, and so am I. These tools aren't just flashy experiments. They're operational improvements that reduce costs, improve accuracy, and make the business leaner and more scalable. This aligns perfectly with the push from retail shareholders themselves. Anthony Pompliano recently compiled and submitted a letter to Opendoor's board, full of ideas sourced directly from retail investors. And these weren't meme-level suggestions. They were serious, thoughtful proposals about how to make Opendoor more efficient, more innovative, and more valuable. The letter called for a CEO with proven scaling experience, potentially someone with the vision of a Travis Kalanick, who built Uber into a global force. It suggested bringing back early leaders like Keith Rabois to restore founder DNA. It pushed for an asset-light pivot, leveraging AI partnerships with companies like Palantir or OpenAI, and expanding services like agent networks and financing solutions. It even suggested improving the app to better compete with Zillow and Redfin, with features like verified self-guided tours. This is not your typical retail activism. This is a retail hive mind acting like a decentralized hedge fund, pooling intelligence and conviction to help shape the company's future. And Opendoor's leadership is listening. Srisha himself has been engaging directly with shareholders on social media, reinforcing his image as a leader who is receptive, hardworking, and forward-looking. So when I look at Monday's trading, I don't see weakness. I see a stock catching its breath after a massive run. I see a community of investors who are more engaged than ever. I see a company that is evolving its model, embracing AI, and redefining its strategy. And I see a macro environment that is about to turn supportive in a big way. Heading into Tuesday, the key level to watch is $5. That's the battleground. If Opendoor can reclaim and hold above $5 with volume, it will signal that the rally is back on track and that Monday's pullback was nothing more than a pause. If the stock dips further, I expect buyers to step in quickly, just as they have in recent weeks. And with short interest still elevated, any sharp move higher could trigger another wave of covering that fuels the next leg up. The road to Eric Jackson's $82 target is long. Nobody expects it to happen overnight. But what matters is that the building blocks are in place. The retail hive mind is energized. The leadership is engaging. The business model is evolving. The technology is scaling. And the macro is turning favorable. That combination is rare, and it's what makes me bullish heading into Tuesday and beyond. So as the market prepares to open, my message is simple. Monday's pullback was healthy, expected, and even necessary. It cleared the air, reset the chart, and set the stage for the next move higher. Opendoor's rally isn't over. In fact, it may just be beginning.